financial advisors that I speak with are adding alternatives in their portfolios to reduce the risk in their portfolios, to reduce the volatility without giving up their returns. They're doing this by maximizing what is essentially the only free lunch that we have in the investing world, and that is diversification. And diversification is the act of bringing uncorrelated risk premiums into a portfolio. So going after returns that aren't completely redundant or locked in with the returns that are in your traditional portfolio. The idea is to find alternative investments that don't run the same risks, meaning they don't go up at the same time and then they go down at the same time as your traditional assets like equities, corporate bonds, real estate, and whatnot. Let's say that you own 3 small businesses, and let's say that all 3 of those businesses benefit from a local military base. So maybe you've got a video rental store, a laundromat, and a convenience store. But you can trace the roots of the risk premiums that those businesses are collecting to a military base. At first glance, you seem diversified with 3 different lines of business, but they're fundamentally dependent upon one economic reality, the military base. My advice to this business owner would be to diversify geographically. It's not enough to just diversify in name only, but you might want to have a tire store on the other side of town that isn't dependent upon the military base staying open. You might want to sell your laundromat and buy a dry cleaning service on yet a different part of town that is maybe more dependent upon some other type of business or whatnot. So bringing in uncorrelated diversifying assets into the portfolio is the best way to maximize the diversification, especially when you need it the most in hostile market conditions.